good evening, ladies and gentlemen. I'm Sankalp Gopal and I take care of business development at PMS World. I'm thankful to all of you for joining with us on, I think, the 9th episode of Emkay Alpha Mavens, which we created with the intention of interacting with the top minds of wealth management, money management, and overall financial services. And, with that in mind, we today have Mr. Jaideep Hansraj from Kotak. I say Jaideep Hansraj from Kotak because he has donned many hats at Kotak. So limiting him to one particular business will be kind of an injustice. And with us, I'll just start with a set of introductions. We have with us Mr. Hansraj, who joined Kotak about almost 2.5 decades ago, and across these years, he has managed many businesses at Kotak Mahindra as an institution. Currently, he heads Kotak Securities. Before that, he was the CEO of Wealth Management and Priority Banking. He, it's kind of a parallel that we can draw with him and the industry that has grown, kind of collectively together. His collective wisdom will give us a lot of insight today. He has scaled many businesses, developed many businesses under the Kotak's, umbrella. And we're thankful for you, thankful that you are here, Mr. Hansraj, today.
Thank you so much for having me over, Sankalp.
Thank you. It's a pleasure. With us today are the usual suspects, Mr. Vikas Sachdeva of MK and Sachin Shah of MK. Vikas, again, has close to 25 years of experience. He's in the asset management business. He's a veteran. He has headed organizations like Edelweiss Asset Management, Inam, and now he's the CEO of MK Investment Managers. He's also been a part of many SEBI committees and AMFI committees. And accompanying him is Sachin Shah, the fund manager at MK Investment Managers, who he is the proud author or the developer of a framework called eCall, which helps judge managements and businesses, and he's successfully managing his PMS and AIF within top-notch returns. And a little bit about PMS AIF World before we get into the last introduction for this evening. PMS AIF World is one of India's top digital platforms for alternates, and we always are a proponent of investments through informed decisions and conviction for the long term. And the last introduction today is for you guys to ask more questions. Is FinLearn Academy, who will be sponsoring our best question award today. Okay, so FinLearn is an online platform for learning about investing, trading, and everything related to the stock markets. So you can check them out. And a lucky winner who asks the best question today gets to win a prize from them. So with that, let me introduce the topic a bit today, which I think, I said that would be the last introduction. But today's topic is very interesting. Vision and strategic intents of top wealth management firms in the $5 trillion economy. So we've always spoken about the wealth being created when Indian economy moves to to add another couple of $1 trillion under its umbrella. But what happens to the money that is created? How will it be managed? What are the top leading organizations envisaging about managing this kind of money? And in general, what happens when a country creates massive amount of wealth as such? So that is what we will try to discuss. That is what we will try to apprehend with one of the top guys in the country today. So over to you, Vikas. And I think I've done my set of introductions.
Yeah, thank you so much, Sankalp. As always, it is my want to introduce the person behind the professional. I think we've just heard a lot about Jaideep, but I just want to talk about him as a person. And what I've heard about Jaideep, some common adjectives which his colleagues, friends talk about is he's a workaholic. He's extremely dedicated to his work. He's business focused. More importantly, his business acumen is at a different level. This is something which I've got from every person I've spoken to. Also, some of the other things I've heard, Jaideep, you're a people's person. You're the go-to person for any employee. In fact, there are several stories people talk about how you stood by employees in moments of crisis. So I think that was really very heartening to hear. On a more lighter note, you're a complete movie buff. And you're pretty omnivorous about your choices, but your favorites are the Godfather series. So I'm not trying to tell anything to your colleagues here. He always has a twinkle in his eye, always good for a laugh, even at his expense. He's a big foodie, and therefore, by the way, there's a high chance that he's very high on any sporting activity. In particular, he's a gymming enthusiast, he loves cycling, and he plays badminton pretty well. Always the life of a party. He loves old Hindi songs, and most people confirm to me that you sing quite well, Jaideep. You're a typical Cancerian. You enjoy the finer things in life. I think one of the things everybody talks about you is that you have a huge tie collection, and you're very particular about the brands you want to wear, which makes it very easy for colleagues to give you a gift when they want to. You love watches. You have quite the collection. But I think what was surprising to me is that you actually love paintings, and you pick up paintings after painstaking research, and you've been doing that for 25 years now. You're very particular about your wear. You're often the trendsetter amongst your colleagues. And there is this incident which people smile and tell me about, that at one point of time you started wearing, those happy socks to office, and very quickly everybody jumped onto the trend and started wearing happy socks. Last but not the least, complete and devoted family man. People tell me that you will always take your family's call, whether it's your wife Archana, your daughter Sanjana, or your son Rahul. Whenever they call, whatever you are doing, whichever meeting you're sitting in, you will take that call at that particular moment. And last but not the least, personal observation, which I think resonates across all your colleagues also. You're one of the most humble people I've come across. You're still the same guy I used to know when we first met in the 90s. So thank you so much, Jaideep, for joining us. It's a pleasure having you here. And let me just dive straight into the topic and ask you the first question.
Sure.
I think Sankapoor did start alluding to it, and let me just be a little bit more, most of us have been fortunate enough, to start our careers around the same time SEBI was formed, 2.5 decades odd ago. Ergo, the vintage in the Indian private sector financial services is also around 2.5 decades. That's when we really started seeing the glasnost which started happening in the Indian financial services sector, probably started happening around that time. What, according to you, have been some of the more defining moments that you would like to highlight in this journey?
First and foremost, Vikas, thank you very much for the very, very kind words. I don't think I deserve even 1% of whatever you said, but if you said it, I humbly accept. It's actually. And when you were asking this question, or when we were talking about it sometime back of the last 25, 30 years of financial services, wealth management, etc., there have been just a plethora of changes. And I think from what the world was in financial services in the early 90s when I got into this piece, and now in the early 2020s when I'm 4 years away from retirement, the changes are just completely crazy. But I think if you ask me for
Jaideep, just can I request you to get the mic a little bit closer? Yeah.
Sure. Is this better?
Yeah, this is better. I think perfect.
There have been just crazy number of changes. I think the big defining moment is going to be I can't pinpoint on one, but I'll try putting out 3 or 4 things which I think have been huge moments of change. I think it started off with the introduction or the scrapping of entry loads in mutual funds. I think the way was shown by the regulator that I want to reduce financial intermediary costs. I think that was one huge moment. The other, I think, has been the realization amongst, I think, all wealth management firms, wealth managers, that there exists a huge conflict of interest, or there existed a huge conflict of interest, and in some cases, I think there existed or there exists a huge conflict of interest between, let's say, I as a banker and a gentleman as a or a lady as a client. And how does one remove these conflicts of interest? I think the biggest conflict was that I as a banker would get paid by the manufacturer, whereas the advice would be going to the client. And the fact that over periods of time, the regulatory changes which have come in, making the RIA concept or the investment advisory concept cleaner and cleaner and more sharper, and I still think there's things going to keep happening. So that to me was the other big thing, or the removal or the eradication of conflicts of interest. People taking clear stands of whether they want to be in the manufacturing space, whether they want to be in the distribution space, or whether they want to be in the advisory space. And so if you look at these 2 or 3 changes, I think have been huge. I also believe that at the beginning, it was hardcore selling what you thought was what you wanted to sell, or what you thought was right, or what you wanted to sell to the client. I think the realization is again clearly there with every wealth manager or every wealth management firm, that it's now clear that you can and you should and you will, or people are recommending things which the client wants, or creating things which the client wants, rather than the other way around. So I think it's a combination of financial intermediary costs coming down dramatically, and I still think it will keep coming down. Second is the conflict of interest removal, one by people who did it themselves, and the other is regulatorily. And of course, the fact that products being designed more suitable, or I won't use the word suitable, products being designed according to client wants rather than what the banker wants.
Interesting. One of the things when you talk, I'm also just harking back in terms of the journey all of these years. One of the things I realize is that when we are all in the midst of change, we are too close to the mountain to see how big it is.
Absolutely.
Yeah. So from that point of view, while seeing all of those, changes happening in the landscape, at a personal level, you have nurtured, built up, and scaled up businesses. If you look back all of these years, what are the changes you have made as a professional to remain contemporary without knowing what regulation will persist, how things will change? What are the few things you've done to remain contemporary as a professional?
I think this is across. I'll actually try breaking this up into 2 parts. One is the overarching piece of technology, and the fact that I am now part of Kotak Securities. I keep saying this to everyone, that I run a tech company, or I try to run a tech company, which happens to be in the securities broking business. Because it's been now 2 years for me in Kotak Securities, and I am absolutely clear about it that technology is going to play, or has played, such an important role in financial services, and it's just the beginning. In any business, I mean, if we are specifically going to talk of wealth management, I see that happening in huge ways. It has already happened, and I see that continuing to happen. So to me, the digitization, the technology drive, which is happening in financial India or in the entire BFSI space or the financial services space in India, is at a pace which is unparalleled. It's got even more accentuated with COVID. What was the before COVID zone, or the BC zone as we loosely call it, and what is the DC zone or during COVID zone as I see it. The changes are just completely crazy, and I say this with all seriousness, that professionals in the financial services space who will not stick to these or will not change with the times on technology will become extinct. So to me, I think that's one of the biggest changes which I've seen. But apart from that, if you are specific on the wealth management space, I'd briefly mentioned it earlier. I think the advisory model, which I think practically every wealth management firm worth its salt today has, or the family office model which people offer to clients, I think are really clear change moments which I've seen in my career.
Very interesting. I think the penny dropped when you said we are a technology company. Incidentally, we also do broking, to paraphrase an ad. Very interesting.
Yeah, it is actually. I don't think I track daily active users, monthly active users, and maybe so would a Zomato, or so would a Swiggy, or so would any of the tech firms. And I think, and I didn't know these words, Mao and Dao, was something which I knew nothing about when I was part of the Priority Bank or the NR business or the wealth management business. Because, yeah, it's never too late to learn.
Sachin, you want to go ahead?
Yeah, sure. Yeah. So Jaideep, like as you said, in terms of what you've seen, the structural changes in the business actually over probably last 2 decades. And if I have to draw parallel, say for example, if we see the broking business, if we go 2 decades back, or maybe about 2.5 decades back, when it was a physical, the ring that we call it in the Bombay Stock Exchange, the brokers used to have 100 bips, 150 bips as commissions. There used to be the jobbing margins and all of that. And from there, probably that inflection point that came is what the NSE digital terminals or the electronic terminals. And then obviously the margins, the intermediary cost has just been sliding down from 100 bips to probably now 1 bip, or maybe now it's even lump sum kind of things. But the absolute profits probably at a pool level has also grown significantly. Like Zerodha itself is now probably doing maybe 500 to 1,000 crores kind of profits, and so many other brokers in the last so many years. In fact, I remember even about 15 years back or so, or maybe about not 15, maybe 12, 13 years back, when I attended the Kotak, one of the Kotak analyst meets, and the profit was like 500 crore, and I was like, it used to be the net worth aspiration of the companies of broking of 500 crores, whereas the profit now was about 500 crores. So we've gone through that big structural change, that in spite of the yields coming down significantly, the overall profit pool has actually exponentially grown. On the wealth management side, are we into that kind of a phase now where probably the market is getting matured, in the sense that there are more and more large families wanting to look for professional advice for managing their wealth? You have much more matured wealth managers now. And on the other side, the regulator is clearly working on getting the intermediary cost, as you rightly said, in terms of effectively the commissions significantly lower. But do you think that this advisory piece that the regulator has gone in, is that an inflection point over, it has it set the ball rolling for the next maybe 1 decade, 2 decade for this business to now get into the next league, into completely a different zone?
But you've asked me too many questions, so let me try.
Jaideep, before you answer that, just let me give you one anecdote here. Not an anecdote, I just ran this poll. I'm so sorry to cut you, but this is very interesting. Sachin suggested a lot of structural changes that have happened, but I ran this simple poll. I think my financial advisor is ready for the next phase of growth or next phase of wealth creation. It's surprisingly only 33% feel that their advisors will be, they're confident that their advisors will be able to meet up to the challenge. Okay, while we are evolving every day. So, that is what I wanted to point out. Have that parents in mind as well.
Okay. Let me try taking a shot at what do I think or what do I see happening in wealth management? And people who happen to be in the wealth industry will have to excuse me if my thoughts are dated, because I have not been part of the wealth business for the last 2.5 years. But let me, at a point of time, and I'm saying this with all humility and not asking anyone on the call to think that I'm trying to belittle any size or any of that kind. But the sheer size of wealth which is increased in our country is mind-blowing. We would, at a point of time, have starting wealth management business would start for clients at a figure of maybe 25 lakhs or 50 lakhs or 1 crore. Today, there are wealth management firms which would have min ticket sizes of 5 or 10 or, that kind of numbers. The kind of focus which I think is there and will be there going forward in wealth management firms of specific focuses on professionals, on NRIs, on what in Kotak is loosely called stake sale transactions. I think it's gonna see a huge change, and as the IPO market is becoming bigger and bigger, the venture capital market is becoming bigger and bigger. Stake sales have been happening, and it's now maybe 8-10 years that there have been people who've been wanting to exit businesses or have exited businesses and created liquidity for themselves. And if people have that kind of surplus, which is a few $100 million kind of surpluses or half a $1 billion kind of surpluses, at that stage, to expect that they would want the same level of service which they were getting when their amounts were 1/100th of that is also very wrong on part of wealth management firms. And that's where customization comes in and it will keep coming. That's where costs will come down dramatically. That's where products will get manufactured specifically for those families. That's where custodian businesses will become important, because people will not want to will want professional custodians to just keep their assets with. That's where trusteeship businesses will come in for managing a succession. It's getting very imminent that a lot of families want one leg of their next generation to not be a country alone, and they want to explore businesses outside. So I think the concept of international jurisdictions is going to become critical. I think the overarching thing around everything which I've seen is tax. People want advice to not only come from their tax advisory people, but expect their wealth manager to have a division within their firm, which would give them advice on domestic tax, international tax, and I've seen all of that happening. Or one is tried creating all of that. That this is what the customer wants, this is what the client wants, and you have to do it because the classic one-stop shop is what a wealth outfit should be. I think you're bang on. I see costs even coming down even more. How well will active fund management be part of, or how much or what portion of active fund management will be part of families, large families, is something which only time will tell. I happen to be on a few family office advisory boards of people I've been close to and who were part of the wealth management business when I was part of it. And when your sums of money are a couple of $100 million, at that point of time, every basis point counts. So I think it's going to be a combination of all of this. And the one factor which is going to be there, which is going to clearly be, I think, a thumb rule for everyone, is that if you're not going to be cost conscious for the client going forward, that's not going to be the way being with the client for a long time. And what do you have to do as a wealth management firm for that? I don't know. OPEX, reduce OPEX dramatically. I think the concept of benchmark strategies is going to just rule the roost. I'm not saying this because I happen to be part of a securities firm, but I've seen this. I was guilty of that in as well. That I see a huge increase in people wanting to be part of direct equities. I see a huge increase of people being wanting to be part of direct investments into unlisted equities or venture capital funds or private equity funds. So it's a sea which I or a change which I see, which is just at the beginning or maybe in the first quartile. And if what Shankalpo's poll says, that only 1/3 of the people believe that their wealth management firm is ready or their wealth manager is ready, maybe I respect that.
Interesting.
So Jaideep, one of the very important points that you made is in terms of the conflict of interest from the advisor and from the client's perspective. And I think if I go back again to the broking days, I mean, that's an industry where we all are very close to. I think as soon as the transparency came in after the electronic trading and because of the DMAT and, the seamlessness of the whole thing, do you think the conflict in the wealth management with this advisory mandate which has come into play now from the regulator can actually, be a stepping stone in terms of, blooming the business big time? Like the amount of the corpus which is today under the advisory business can actually go significantly multifold, because now the advisor is actually just going to work from the perspective of the investor, as you said, from his cost.
India will change. India will change very fast. And I heard one thing, that when change happens, it happens so fast that before you say whatever, Robinson Crusoe, the change is happening. And I see that happening consistently, whether it's on what you mentioned of advisory people or whatever. But wealth creation in India is happening at a pace. And if from the current levels of close to a $3 trillion economy, one gets to the $5 trillion economy, the creation of wealth is going to be so huge again that and it's going to percolate at all levels. I think it's not only going to be a particular set of people which will make the money. I think it's overall. If the economy is going to go to 5 trillion, I mean, yes, the last couple of years has been a dampener from a GDP growth point of view. But if the economy is going to go to a $5 trillion economy, the wealth creation in our country is going to be humongous. If the wealth creation in our country is going to be humongous, people will require genuine, solid professional advice. And it is up to the firms in our country of what stand they want to take, whether they want to be a manufacturer of the investment product, whether they want to be a distributor of the investment product, or they want to be an advisor to the client. And I think all three have a huge role to play going forward. But it's going to be stands which individual firms, individual owners, individual CEOs will have to take, that they want to be in all three. I think all three is tough. It's got to be a combination of 2 out of 3 is what I see happening. But it's calls which firms have to take.
Yeah, so that's again a very interesting point, and I'm going to now turn the tables the other way around, saying that we know about this, that the wealth management firms have to have a very high amount of integrity in terms of with their clients and completely under the client's interest. But at the same time, they are grappling with in terms of the lower margins or lower.
I don't think there's any option to that, Sachin. Then they better not be in the business, because if they believe that I want to be in the early 2000s or the early 2010s, taking those kind of margins, I think margins will. There is no doubt in my mind that margins are going to come under pressure. There's going to be. I mean, I'm today part of a business which has zero brokerage. It can't go lower than that.
Yeah.
And as you said, that there are firms which are making profits, which are very, very handsome profits over the last couple of years. And I see that happening. It is going to happen. India will clearly move from being a nation of savers to a nation of investors, because as you have situations of interest rates being at these levels, which is not even beating inflation, it is bound to happen. It's staring at us in the face that it is going to happen. That we will necessarily have to change from being, or Indians at large will necessarily have to change from being a nation of savers to being a nation of investors, and it's happening. I mean, we all know, or we all read about this, the number of demat accounts which are getting opened, the number of new customers which are going into equities, the number of new mutual fund folios created, the number of SIPs which is growing. I saw the last count was, I think, close to 10,000 crores now. It's staring at us in the face, and if this number will definitely multiply. It's not going to be a pure, simple, nominal Vidwa growth, as I used to call it. It's going to be good, solid growth. So it is going to be. It's just a matter of time. But if people believe that the percentage of margins which was being made even 2 years ago will continue to be made. I wish them luck, but मुझे नहीं लगता कोई भी ऐसा सोच रहा है. I don't think.
But they are finding some ways out, right? Like they will try to have some exclusive product. They will try to have some captive product where they can have some extra. He'll push, like, out of a basket of 5 products, I'll push one product which will have a higher margin.
You'll have such I understand your line of questioning, but if this was something which was maybe half a decade ago, I would have said, but today, believe me, I think if a wealth management firm is serious, and I think wealth management firms today are serious. I think wealth management firms realize that what is the potential in selling a wrong thing to a right customer and losing him for life. The life value of that client is so high on an NPV basis. I don't think it's in anyone's mind to do this. If it is happening, it will not happen for a very long time. I'm very sure of that.
But then the wealth managers only keep on changing their jobs so frequently.
Again, the answer to that, and I'm not trying to protect my earlier profession, but I think that also is changing. I mean, the fact that there are wealth managers, and you can pick on maybe a particular percentage, but there are a reasonably decent percentage of people who've been in the wealth management industry for more than a decade. There are firms which have been formed more than a decade ago, and people have been part of those firms for reasonably long periods of time. So each of these industries will have its own views, but I don't think it's good to catch everyone with or try to catch everyone with the same nest.
No, sure. Frankly,
Sachin, yeah. I think. Sorry, I'm just going to be. This is a very interesting discussion, but I'm just going to be interjecting with 2 points. One is, I think amazing questions are coming in from the audience point of view, and I have some very naive questions I want to ask Jaideep myself. So I'm going to be asking you to just let a few of our questions come in, and then maybe we can continue it. And we are now already in 40 minutes into the conversation. The number of questions are coming in, the number of people are going up. So I don't see this stopping in a hurry, right? So Jaideep, one question which I have, which is going to be a little bit away from public markets in a way. When I started thinking about this question, when I started writing about it, India had 21 new unicorns. Till yesterday it was 22, I believe. Now it is 23. So 23 new unicorns till date, which means that the value of new age businesses in this country is probably being recognized, and it is going through the roof. Not surprisingly, it is also getting a lot of participation from Indian investors, Indian HNIs, family offices in these private markets. It's inevitable, I guess, both on the credit and equity side. My fundamental question, it's broken into 2 parts. What are the challenges these businesses will face once they come into mainstream public markets? And the second thing is, how should these investors who are already into private equity or into the private markets, when these businesses go public, what should be their course of action?
You've got enough of examples, Vikas, of firms which have gotten into the public market space. Okay, you won't have enough examples, but there are few examples which are there today of people who've got into public markets, having been predominantly private for a reasonably long period of time. I think the big issue which they would face is that today they were answerable only to maybe a few dozen, or not even maybe few dozen, maybe a few handful of investors or a few handful of shareholders. and it was them which they were answerable to. I think once the public market thing is opening up and they've taken a call to be in front of the public market, I think the scrutiny levels are going to get higher and higher and higher. But I again don't believe that they're not ready for it. They learn. I mean, it's a process which is just a matter of time, where some of them will make a few mistakes on the way. Some will struggle, and some will see the people struggling or making the mistakes, and those mistakes will not happen in the future. From an investment point of view or an investor point of view, people who have invested in these unlisted spaces, either through funds or directly, I think the call which the family office or the ultra high net worth individual, and I think I would restrict it as of now only to these two categories of investors in the HNI space who've invested in these unlisted equities. It's a call which their family offices, themselves, the families would end up taking, whether they want to exit part of it during the IPO, whether they want to remain in it for a longer haul. But what I see happening very clearly is that I see more and more participation coming about in the unlisted space, in the venture capital space, in the angel investment space, from a completely different set of individuals than what it was in the past. And that is heartening. At the same point of time, I would put in a word of caution as well to investors who are getting into the unlisted space. Do not allocate large sums of money or large percentages of your assets into the unlisted space. Dip your toes, dip your feet, experience listed equity, and then look at unlisted equity. Don't take a call saying that I'll go first full hog into unlisted, because the kind of returns which my friendly neighbor has made is so huge that I'm also going to make that. It doesn't happen so easily, but I see that happening. But I see the unlisted space getting much more subscribed to by a far more wider set of people than before.
Interesting. I think the analogy which you gave about dip your toes, dip your feet, the swimming analogy, I was told when I was learning swimming, dip your feet, dip your toes, dip your trunks, but make sure you don't dip your nose. Udhar aane ke pehle, just make sure you learn how to swim. And I think that is true for all markets which you talk about, particularly I think for private equity markets right now. I think that's very useful information. I actually had a question, but you've already answered that, so I'm just going to turn it into a comment before I hand it back to Sachin. About democratization of the wealth management business in terms of advice. I think there is so much of information out there. The client has become savvier. Information which used to be at the premium, which is restricted to a particular sort of advisor or entity. I think it is getting more and more democratized, and which is one of the reasons why probably the costs are also dropping in a way for advisory.
No, because I'll also add one more thing. I think it's also important, and I hope on this call there are investors as well. I would sincerely request that don't put undue pressure on your wealth manager or your advisor to say that I want returns which are high double-digit returns or mid-teen returns, because it is not possible. If the net worth if the GDP of our country is going to be growing at a particular percentage, the underlying stocks or the underlying companies which are part of the GDP are also growing at that same percentage. So if the GDP is going to be growing at sub 10, then to expect high double-digit kind of returns in equities is not correct. By putting pressure on the wealth manager, you might end up asking him to do things which are more risky for your portfolio, which ultimately will not be good for the financial health. So I think it's a request to investors as well, that be 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 very reasonable in your expectations of what is the return which one should be making. It was very nice to think that I could make a post-tax return of 12 to 15% in equities, but that was a time when taxation rates were not there in long-term equities. That was a time when the inflation numbers were north of 6, 7, 8%, and at that point of time, it was easier to make that kind of return. But at inflation numbers which are there today, the way they are, to expect those kind of percentages, I would sincerely request people to be reasonable in that.
Manage your expectations. Understood. Sachin, over to you.
Sure. Thank you. Yeah. So Jaideep, I completely agree with everything that you said, and it's just that sometimes I try to be a devil's advocate. In my typical habit of being a research analyst and a fund manager, when we go and meet the management, we try to, get sense that what we are thinking, let's get a reaffirmation from there. But I completely agree with everything that you mentioned. What we've also seen in the recent years is that, if I go back to again when we started our careers, the MNCs had they were the leaders in as far as the wealth management is concerned. Even the aspirations of the wealth managers would be to work with an MNC wealth management firm. But in the last few years, the firms like yours and a couple of large firms have actually taken the pole position. How do you see this now trend from here on? Do you see that you'll be able to further capitalize on this trend as a business?
It's a very good question, Sachin. And I used to. I don't think I any longer do it. But if there's help which any of my ex-colleagues want, I obviously try providing my inputs, however shallow they might be. But I think the big differentiator for a wealth management firm is going to be whether you're part of a bank or a non-bank. When it becomes a non-bank, you're talking of whether you're part of a broking entity or a NBFC entity. When you're part of a bank, again, break it up into two parts, whether you're independent or the wealth management business is independent, whether the wealth management business is part of the consumer bank or the wealth management business is part of the wholesale bank. So you can have any of these 5 verticals under which the wealth management firms can sit. That is, I repeat, standalone bank, standalone entity, which is what Kotak was and is, part of the consumer bank, part of the wholesale bank, part of, or if you're not part of a bank and you're part of either a broking entity or you're part of an NBFC entity. Now, there could be some cases which could be out of these 5 as well, but I think if you break it up, it would all form part of one of these 5. Yeah, I think an asset management business could be the 6th. A pure, simple foreign entity could be a 7th. So, these are the broad places. Again, I think each firm needs to take a call on what or how does it want to intend to grow. I think what I have experienced is that in this convoluted space of or complicated space of finance and advisory being critical, the kind of clients you're talking to in the wealth management, I think from a bank perspective, if you're part of the wholesale bank, or if you're part of an independent outfit which has reasonably decent working relationships with the wholesale bank, and when I mean wholesale bank, It could be the investment bank for mergers and acquisitions, for IPOs. It could be the corporate bank for lending. It could be the mid-market segment again for lending. It could be ease of transactions. So it's really a combination of what is it that you think your client base is and what is it your client base wants, and then adjusting your offerings and your structure accordingly. Similarly, if you're a standalone broking entity which wants to offer wealth management business, or a standalone asset management business which wants to offer wealth management, I think it's just where do you think the sweet spot lies for you is what you need to figure out. And as I said, the difference for us in Kotak was the fact that it's a universal wealth management kind of a situation with a lot of working relationships with various parts of the group, because ultimately the client decides what the offering should be, and you have to figure a way out within your system of how you're going to offer that. If he wants an investment banking advice, you would ideally, or you should ideally, be in a position to give him that within the group. And if you can, then it's just more and more strengthening of the relationship. And I think that's where wealth management firms have made or broken themselves.
Sure, perfect.
How you decided to structure your business internally.
Right. So basically, have your focus, get your audience absolutely earmarked, and then that's where you get your business, right? Earlier you also mentioned about that that you are in a technology business and you happen to be in a securities business. Any 2 or 3 trends in the fintech space which is on your radar, or which is like you are really very much focused on? Any 2 or 3 trends that you would like to talk about in the fintech space?
I would call it the fintech space, Sachin. I would just say, how is digitization going to become bigger and bigger? I'll give you very small examples, and it necessarily has to be the focus of firms, whether they happen to be in the securities business, or they happen to be in the food delivery business, or they happen to be in a small payment bank, or whatever. At a point of time, okay, a broking account used to take 7 days to get open. Okay, today, I think it would be 10 minutes or 15 minutes. Now, that is the extent of the role which the technology piece or the digital piece has done. And I've seen this happen in front of my eyes. When I say change happens and you don't realize it. And there are people I know who are trying to get that down to 4 minutes. Now, 4 minutes for a broking account to get opened, obviously subject to XYZ sets of parameters. But that is the extent of focus which is there on today DIY or do-it-yourself kind of thing. It's again in the tech space, wealth is not. It's not simple. It's a complicated thing. I mean, you've got a wealth, a client who's got money with 5 different mutual funds, 6 different PMS managers, 3 different AIF managers, 2 different venture capitalists would be part of AIF, would have some part in the 250,000 LRS. He wants to know one consolidated report for himself. Now, your technology needs to necessarily provide him that. And people who will succeed in doing this will be the preferred wealth managers. And if they charge you a few bips more, you'll still happily pay it. I think I didn't mention anything about the emotional quotient or the relationship manager field. I think it's going to continue to play a very, very important role. There are going to be people who'll shift businesses because their wealth manager has shifted or relationship manager has shifted. So I think it's going to be a combination of tech, human interface. But I used to say this frequently at the beginning of my career, that it's this business is about people and product. I then changed my philosophy to say it was product first and then people. Today, I think it's a combination of people, product, process, and platform. And product is not the way we normally understand product. Product is the entire offering which you're putting in front of the client. And that to me is product. Is the platform which you're offering your offerings on, is that friendly to the customer? Is he happy in the entire process? Is it too complicated? Are you asking him too many signatures? Are you going to keep how easy can you make it for? So it's really now to me 4 P's. It's people, and I it's not only for the wealth business actually. I see this extremely strongly in the securities business which I'm currently part of. It is platform, product, people, process is what I.
And do you have an order for that? What comes first? What comes second? Like as you said, first it was people, then product, then you changed it.
Today, I think today, from a securities firm point of view, I'd say platform.
Okay.
First, and then everything else.
Okay, interesting. Very interesting. Very interesting. You have any thoughts for asset management firm? What would it be? I'm asking from my perspective.
Make money for the client, man.
No, that I understand. But what
Touche. You make money for the client will come to you.
But I think we're running out of time as well. Last minute anyway. But I think 2 things which I think, or 2.5 things which I think will explode in India is benchmark funds, ETFs, because of the fact that people are happy or content with getting indexed returns. So they would obviously, if they get a couple of 100 basis points more, they're not going to say no to it at all. But at what cost is going to be their mantra. And the second, which I'm surprised hasn't happened at the pace at which I thought it would happen, is long-short hedge funds. I think it is just a matter of time before hedge funds or long-short strategies become far more bigger, and it could be just an X factor there rather than a pure simple percentage increase. I wouldn't be surprised if the industry becomes, 5x in the next couple of years.
Interesting.
Thank you for that. Thank you. What do you think?
No, I think I've been enjoying myself listening to this. I've never seen a fund manager so actively involved in discussing. I think you really were putting on a research analyst hat. I don't want to interrupt the conversation at all. In fact, in the interest of time and in terms of the quality of questions which are coming in, I will probably not ask you any further questions. I'm going to ask Sankalpo to take over because some of the questions are really amazing. I think you should look at those. Sankalpo?
Sure. So we'll take some questions from the chat, and the first question I'm going to take is from Pooja. So she asks, can wealth management or financial services be more broad based when they give their advice? Like she gave the specific example, okay, that I began a monthly sip of 10 grams of gold, but then I realized I was never given such a plan by any advisor. Okay, similarly, when I was thinking about it, if somebody told me when I was 10 you could start an SIP and you could buy your first bike with that when you were 20, or you could fund a part of your education when you are 20 with that SIP that you did for the last 10 years. Okay, so can this kind of advice more centric to a broader base of investors, okay, and not just one size fits all kind of approach, which I'm not saying is happening today. A lot has happened. Wealth managers take that on their stride and try to devise individual plans. But can that become more broad based, where we cater such things also?
I think it is going to happen, Shankalpo. It's again a matter of time before it happens. I think it's a very good question which Pooja has raised. I see it happening. In fact, there's something happening, I know for a fact. But this is going to be far more digital. This is going to be far more standardized than customization coming into it. I think goals, life goals, acquisition goals, and when I mean acquisition goals, I mean buying a bike, as you said, or buying a house at a particular age, or saving up for a US vacation. I think all of this is going to become standardized templates, which are going to be obviously basis certain thoughts of the advisory firm, but it's just a matter of time before you see this or all of this coming about. And, whether it's 10 grams of gold, whether it's 50,000 rupees ka SIP, whether it's 5 lakh rupees ka SIP, it's really going to depend on what is it that you want to achieve.
But you see such standard templates coming on.
I do that. I do definitely see that happy.
And we hope it comes sooner than later.
It will. I would be. I think you'll see it this calendar year, man.
Oh, so Pooja, that's answering for you, and I hope such things do come soon for the benefit of all. The next question, which I like, Vikas and Sachin, please feel free to choose from the chat as well. So we've asked this question again and again to a lot of people, and we also ourselves as advisors get asked about these questions, which is about RMs changing jobs frequently, and it's infamous in our industry. Okay, I mean, it's just an elephant in the room. But you have been a veteran with one organization. You've handled teams. You've handled many teams. You have stayed and built organizations. You've stayed with this organization through thick and thin. What do you think of this, and how do investors take it? Look at this thing about our industry, financial services.
It's a tough question, Shankalpo. I don't have a standardized, ready-made answer for this. My submission would be select the firm and then decide on the wealth manager. Because if the firm is right, if the processes of the firm is right, if the product selection of the firm is right, if the safety, risk management, compliance of that firm is right, irrespective of who the wealth manager is or who the relationship manager is, you will continue to be in safe hands. So don't get carried away with the fact that my wealth manager was with A bank first or B wealth management now, and he's gone to C, then he's gone to E. Don't think of that. My humble suggestion would be decide on the wealth management firm first. And there's no harm in having a couple of wealth management firms. I've seen this, that people are very comfortable with having 2 or 3 wealth management firms. Obviously, it depends on the size of the asset, size of the funds you're placing with that firm. But you will eradicate this problem in its entirety if you decide that this firm I'll stick with.
It's interesting that
It's around this firm are right, the compliance around this firm is right, the risk management is right, the product selection is right, the process is simple, platform is good. That's what I would say.
In fact, I just before you go to the next question, it's interesting because Sachin was asking a question in terms of ranking of parameters. You talked about platform, process, product, people, and you said platform is first. When I hear you very carefully, I'm getting the feeling that maybe process is second. And that is something which might be of use to our viewers. Sankalp, please go ahead.
Sure. So the other question that I want to ask is, you spoke about. So this is something again we have seen in the industry happen everywhere. I think, not sticking to any particular geography, but 2-3 players become very large and start having 40, 50%, 60% market share. Okay, across financial services. What do you think then becomes the risk? Okay, this I think Susmit Patodia asked this question in response to your. Companies becoming large and OPEX coming down lower. So what do you think of those risks coming to India?
I think firms will become big or bigger if they have, again, I go back to the same old thing, that if they have their eyes set on the right focus and do what is absolutely customer centric and right for the client, they will or it will become bigger and bigger and bigger. All I can advise every wealth management firm, and maybe I'm lack of hair and gray hair, and I can afford to say that if we focus on the right parameters for a client, we will become big. It's only by focusing on the right parameters that firms will become of some substance in this business. Yeah, otherwise there will be issues going forward from a survival point of view, and it's not been easy. The last half a decade or a decade has not been easy. I've seen 92, I've seen 97, I've seen 99, I've seen 2008, I've seen 2014. So it has its own set of troubles going ahead.
Right. So Vikas, the last question that I can take, and then maybe if you can select a few from the audience question, which I think is again a very interesting question. Sorry, Vikas, I'm picking all the interesting ones first.
No, it's okay. It's okay.
So I think 2 people have asked this question. Vikas Kothari and someone else also asked this question. What will be a bigger disruptor going ahead when we multiply the wealth, tech or regulations? According to you.
Regulator will never be a disruptor, actually. Regulator will be an enhancer in the long run for firms becoming or processes becoming cleaner, neater, etc., etc. So you might have very short-term blips in business or profitability because of some regulation which has come, which might have hit one and not hit the other. But the biggest disruptor is going to be tech. I mean, I was a wealth management firm based out of Singapore has and catch hold of your seats for this, has 2,500 people in technology and 500 bankers. But 2,500 people in technology.
5 times.
5 times. 5 times the number of bankers. Now, maybe that 5 times will become 3 times going forward, because you might not now add as many tech people as you would add bankers. But to me, tech is going to be the single biggest, and I say this with so much of conviction and passion or belief, because I'm seeing this happen in my business to a dramatic extent. And I would urge all wealth management firms to key to this.
So Sachin, I think you can take one question. I'll take one question before we wrap up. Please go ahead.
Sure. I have actually a lot of questions. As you can see, I'm thoroughly enjoying this. But just one thing, and that I think it's a function of what I want to really understand is that, last 2 decades, as we all are saying, that's something that we are in the midst of the whole thing where we are so close, we miss it, right? So 2 decades back, the only thing that I had to do was just buy Kotak Bank and Kotak shares, which we never bought, but that has been the biggest wealth creator, right? And so Jaideep, what I want to like to understand is that, to my mind, and which is what we talk about in our research processes, the equal model, that the real wealth creation is a large part is, opportunity, business, everything is there for everyone, but it's the management which makes it or breaks it and which capitalizes the real opportunity, which is where Kotak as a group has done a phenomenal job in the last 2 decades in front of my eyes. And I think the credit goes to the entire management team. And of course, the most important thing is that the management team has actually stuck there. I mean, the senior management team, maybe about more than 2,000 people, or maybe even more, maybe 20, 30 people, have been there for almost 2 decades now. So what is the secret sauce for this, in the sense that why have you all stuck there and you haven't looked around, like in so many businesses? In fact, we just got this news flash a few minutes back while we are here. Mr. Vinod Dasari has resigned from iShares. So he was doing very well at Ashok Leyland. He came to iShares. We were very much hopeful. He's again left. So we've seen this kind of portfolio, the management churn very regularly. But Kotak is one place, and again in an industry where there's the highest churn. I mean, which is our industry, we have the highest churn. But where Kotak is one place where we have seen the least amount of churn in the senior management team. So can you throw some light? What has really played out so well?
Let me try taking a shot at this. I think it's a combination of 2 or 3 things, Sachin. When we set out to do what we set out to, there was no concept that the market cap is going to become so big that that things will become 5x or 10x or 200x or 300x or 500x. I think if you ask me, I think it's really the mentality of a lot of people in the senior management, the complete simple humble mentality of people I'll use the word middle class mentality of doing things the right way. I don't think anyone would have thought, except maybe Uday, would have thought that this kind of wealth creation could happen in this company called Kotak Mahindra Bank. And when it happened, you realized that you were just extremely lucky to be part of it. And you were part of it because of, as I said, the value systems, the culture, the risk management systems, the adherence to being on, not even on the line, but within the line. And I think it's a combination of all of this that when it was happening, you didn't realize it was happening. But when it's happened, then you just think that you've been lucky to be at the right place at the right time. And there's no ostensible reason for you to give this up. So it's actually a combination of, as I said, the cultures and the value systems which have been there in and around you for a very long period of time. I don't know whether this is a answer, which is.
But I'm sure Mr. Kotak also has a role to play in keeping the herd together.
Of course, I told you that. It is the, as I said, no one apart from him would have thought that this would have actually happened, or maybe few people apart from him would have thought this would have happened. I didn't know it.
It's interesting, Jaideep, that when you're mentioning this, I'm reminded of this book I read called Leaders Eat Last by Simon Sinek. Okay, so pretty much a lot of things which you're saying, it just I think these are the definitive traits of any successful management team. I'm not going to, Sachin, if you're through, can I just are you through with your question? Yeah.
So for my other questions, next session with Jaideep.
So I just want to thank a lot of people who've been posting questions. Sorry, Cyrus and Kashyap and Rajendra Shinde, Anish Devasia, Amit Pandey. My goodness, how many people? Susmit Patodi already been asked. Pooja has been asked. Anand Sarore, Sunil Senani, Gaurav Tiwari, SPS Chauhan, Vedant, Finsurf, Manish Balwani, Rahul Chadda. Okay, there's one tongue-in-cheek question I'm going to come to from Nilesh Hunswadkar. I just wanted to end with that because it brought a smile to my lips. And then, of course, we have Rishabh Adukia, Vikash Kothari, Amit Pandey. Sorry if I missed out on any, Pooja Birla, Shivendra Parihar. So this tongue-in-cheek question, which I really smiled. And if it's the same Nilesh Hunswadkar, I know it is typical of him to ask this question. Which type of investors don't need a wealth manager? I started smiling when I saw this.
No, I will. I'll answer this question. I don't think anyone doesn't need a wealth manager. I think every person needs a wealth manager. There can be different types of involvement which you expect out of the wealth manager. Some would be very low key, some would be high intent, but I don't think if you have wealth, you definitely need a wealth manager.
Ergo, if you have a wealth manager, you will definitely create wealth. So I think in terms of all the questions asked, if it's okay with you, Jaideep, I think Pooja, who asked the question on the broad base versus the single sort of segmentation question, should we give her the prize for the best question?
Yes, absolutely.
Okay. Congratulations, Pooja. Our team will be in touch with you. So on behalf of all of us, Emkay Investment Managers, PMS AIF World, and all the listeners who tuned in, on the viewers who tuned in, thank you so much, Jaideep. This has been an amazing sort of a discussion. I didn't even realize we have 1 hour 20 minutes. Time just passed by. Okay. And for me to keep quiet for so long is also very difficult. So I think I completely enjoyed the discussion. Thank you so much for this. Thanks.
Thank you, Jaideep. Thank you, Vikas.
Thank you, all of you, for having me and patiently listening to an old hag. Thank you very much.
Thank you so much, Jaideep.
Thanks.
Bye.
Have a nice evening. Thank you.
Thank you.